In today's video, we're going to be going over the 3 different types of life insurance that we have here in Canada. So we have term life insurance, and then we have permanent life insurance, and with that, there's 2 different types. So there's whole life insurance, and then there's universal life insurance. And so we're going to be describing the differences between these different types of life insurance, and by the end of this video, you'll know which one is right for you. What's up, guys? For those of you who do not know me, my name is Philip Setter. I'm the founder and CEO of Affinity Life, which is an online life insurance brokerage here in Canada, where you can actually view quotes 100% online without having to put in your email or go through a process or get on the phone call with anyone. You can instantly view them online and actually apply online 100% without having to do any type of Zoom meeting or go to anyone's house or have any type of in-person meeting. So it's all done 100% online. So if that sounds interesting to you, I will put the link in the description below and you can check that out. But without further ado, let's just get right into the video. Okay, so like I mentioned in the intro to this video, we really only have 3 different types of life insurance here in Canada. We have term, and then we have permanent, and with permanent, there's 2 options, whole life and universal life. So the first one that we're going to be talking about today is term life insurance. So term life insurance, how I explain it to my clients is it's very similar to renting a house. You would sign a contract in a house for maybe 1 year, maybe 2 years, maybe 3 years. Term life insurance also has a similar mechanism where you can choose a length of term. So typical lengths of terms for term life insurance is 10 years or 20 years or 30 years. And during that period, your rates are going to be fixed for that period. So if you're paying $30 a month, you're going to be paying $30 a month every single month until that term is up. Now, you might be asking yourself, what happens when the term is up? What do I do at that point? Well, there's a few different options that you can do at that point. So the first option you can do is you can cancel that contract and you can go out onto the market and you can see what life insurance rates are around that time and see if you can get a better rate with maybe another company. That's the first option. The second option is most companies here in Canada, and I say most because not all of them, so make sure if you do get some type of term life insurance option that it has this feature, and that's something known as renewability. So what is renewability, okay? Well, that's where you get to the end of the term. So let's say it's a term 10, and for whatever reason, maybe you have some adverse health conditions that don't allow you to now go out on the market and find life insurance from another company because maybe you had a heart attack during this time period, maybe you're diagnosed with cancer, maybe you had some type of adverse health conditions that's preventing you from getting life insurance from another company. Well, what do you do at that point? Most companies will have this renewability feature where you can then renew the term for another duration. So whatever it is, if it's a 10-year, it'll renew for 10 years. If it's a 20, it'll renew for 20, okay? However, at that point, the rates will jump up to a new rate. So usually it's around 2 to 3 times what the original rate is. So if you were paying $30 a month originally for the first 10 years, now you're going to be paying, let's say, $60 to $90 a month for the next 10 years. Now, the reason they do this is because, of course, they priced it on the fact that you would have this for 10 years, and now you're 10 years older at this point. Now, if you picked a term 20, it would be similar. It would be renewed for another 20 years. So it'd be a fixed rate for the first 20, and then it would jump up for the next 20. So what I recommend to my clients is, of course, it's going to be cheaper if you pick a term 10 or a term 20 over a term 30. The lower the term, the cheaper it is. However, if you know that you're going to need this term insurance for 30 years, then I would recommend just picking a term 30 for 30 years, because if you do have to renew the rates, it's going to be much more expensive in the long term than if you had just picked the term that you needed in the first place. Now, the third option you can do when your term expires is, again, most companies in Canada will have a convertibility option. Now, what does that mean? Convertibility option is where you can actually convert your term insurance into a permanent type of product. And again, we're going to get into these different permanent products later in this video. However, the benefit of this, again, is if you have some type of adverse health condition that prevents you from going out into the market and buying life insurance from another company, then this is a really good option for you, because even though you'll be assessed at your attained age for that permanent life insurance, you can qualify without a medical because you're just converting it into a permanent life insurance policy. You're not going to have to go through a full medical underwriting process. Now, term life insurance usually expires around age 85. However, I don't know too many people that still have it at that age, because the older you get, the more that the premiums will cost you. Term life insurance is really good for individuals that are looking to cover themselves for a specific period of time. Like I said, it's an incredibly inexpensive option. This is really good for young families that are just starting out. They're looking to cover themselves for the next 20 to 30 years. Maybe they just got a new baby in the house. Maybe they bought a house. They just got married. There's a lot of financial responsibilities right now. And if one of the partners were to pass away, one of the spouses were to pass away, there would be large financial difficulties that would arise from that. And term life insurance is a perfect product to cover you for that specific period of time, maybe until you're, let's say, 50, 55, or 60. Your kids are out of the house at this point. Your mortgage should be paid off at this point. You'll have some savings at this point, and the need for life insurance will not be as high. And by the way, if you are looking for term life insurance products, you can visit affinitylife.ca, and I'll put that link in the description below, and you can instantly view quotes and apply 100% online for term life insurance here in Canada. So if that sounds interesting, check the link in the description and check that out. So what happens at the end of the term if you still have a need for life insurance? Now you're maybe looking towards estate planning. Maybe you're 50, 55, or 60, and you're thinking, I want to leave something behind for my children, or I know that I'm going to have some tax bills upon death that I want to have taken care of by life insurance. Well, now we start looking at a few other products. That's whole life and universal life. And both of those products are permanent life insurance. Now, permanent life insurance is really meant to cover you until death. Term life insurance is just meant to cover you for a specific period of time, and it's priced accordingly. So what I mean by that, with term life insurance, the insurance company doesn't think you're going to die. There's a chance, and that small chance is what's known as mortality rate, and that's what they factor into their pricing. So they say a small percentage of people will die, and we're going to factor that pricing in, and that's why it's an incredibly inexpensive option. But with permanent life insurance, it's not an if, it's a when, because permanent life insurance is meant to cover you until death, and that's why it's much more expensive. So typically, permanent life insurance can be anywhere from 4 to 6 times what a term product would cost. So again, if it was $50 for a term product, it could be anywhere from $250 to $300 for an equivalent permanent life insurance product. So who is permanent life insurance right for? Well, again, I would say that it's really right for those individuals that are looking towards estate planning. They're looking at maybe taxes upon death. They're looking at leaving something behind to maybe their children or their grandchildren. Maybe they want to leave something behind to charity, or maybe they have a disabled child or grandchild that they want to make sure is taken care of in the event that they did pass away during their retirement. These are all really good reasons. Now, you may have heard somewhere on the internet, or you may have talked to someone, or you've seen this before, where advisors will pitch the idea of buying permanent life insurance as an investment vehicle. So you may have heard this before. You can buy life insurance and you can borrow from it, and you can use it as an investment, and you can use it during your retirement. And I made a much longer video. It's about 40 minutes where I really break into the nitty-gritty of that specific strategy, and I'll put that video there. However, I'll just give you a quick Cole's note of my opinion on this. This could be a very, very good strategy for a select group of individuals in Canada, and I'm talking about the high net worth individuals, the high income earners individuals that have maxed out all the other traditional investment vehicles, such as your RRSP or your TFSA. You've already explored other investment avenues, and you're really looking towards some type of alternative investment that can give you that tax advantaged vehicle where you can allocate more of your assets. Now, with that all being said, I would say that it's not a good idea for the vast majority of Canadians that you still haven't maxed out your RSP or your TFSA. You still need to look into just traditional investment vehicles. There's a lot of strings attached. There's a lot of moving components, and there's a lot of things that can go wrong with this strategy. So I would take it all with a grain of salt. And if you're interested, watch that video that I put up before to get a full idea of exactly how this strategy works. Now, let's just get into the two different types of permanent life insurance. And I'm going to be looking at these from the lens of you're just using it as a permanent life insurance product. You just want to give something to your children, maybe your grandchildren, maybe you want to use it for tax purposes upon death, not through the lens of using it as an investment, because that's totally different. So the two different types, as mentioned, are whole life and universal life. So let's start with whole life. So with whole life insurance, there's two different kinds you can get. You can get non-participating whole life insurance, and you can get participating whole life insurance. Now, with participating whole life insurance, you are going to participate in the returns of the insurance company. So the insurance company will take your premiums and then they'll allocate a portion of that to different investments. They'll invest in different fixed incomes and stocks and bonds and other investments here in Canada and around the world. And when they get a return on those, they return those to you. Now, you get these back in a number of different ways known as dividend options. However, most of them can be boiled down to this. Number one, either your face amount is going to be increased over time, or number two, your premium is going to be lowered and some of those premiums are going to be paid for you. That's really it at the end of the day. So you might pick an option where your face amount is increased over time. And so let's say maybe you started with $1 million of face amount. Over time, maybe it grows to 1.2, 1.5, 2, 2.5. Or the other option where your premiums are going to be decreased over time because they're paying them on your behalf, essentially. Now, really the nice thing about whole life and the reason why people pick whole life is because of the guarantees that are built in with these products. So with whole life, how I explain term life insurance is that you're renting a house. Now, with whole life, this is where I explain you're buying a house now, okay? So of course the premiums are going to be much more. However, once you own that house, you own that house outright. It's the same with whole life insurance. So you can choose a length of payments that you're comfortable with. So you can do 8 pay, you can do 10 pay, you can do 15 pay or 20 pay or life pay. And what this means is that you're paying for those number of years. However, at the end of those years, you're done paying for that product. You now own it. So here's an example. Let's say you pick a whole life 20 pay. That means you're paying the premium for 20 years. At the end of those 20 years, you now own that benefit. You own that contract. You no longer need to pay for it anymore. However, whenever you pass away, whether it be anywhere from year 1 to year 20 or any time in the future, that benefit will pay out. So the benefit of whole life insurance is that it's contractually obligated, it's guaranteed, you can pick a payment term that you're comfortable with, and then you can just pay that, and then you're done paying for it. You own that face amount. So whole life insurance is really right for those people that want those guarantees. They don't want to manage any of the product themselves. The insurance company is going to manage all of those investments, and everything that they're doing to get you a return is done on their part. You're not doing anything. It's guaranteed. It's contractually obligated. It's easy, it's simple, super easy to understand, and it's a good idea for those people that just want a very simple, easy solution, and they're okay with losing out on a little bit of the upside in return for all those guarantees. Which brings me to the next product, which is Universal Life. So Universal Life is a little bit different, and it's a little bit more complicated, and it could be better, it could be worse, depending on a variety of different factors. So with whole life, you really are getting that guaranteed. You pay for a period of time, you get the benefit, and you're on your way. Universal Life is much different. It's much more flexible. You have a lot more options. You can change a lot more things about it. But with all that flexibility and with all those options comes room for more error or more mistakes. And you need to be careful and make sure you're managing this product properly, okay? So with Universal Life, you basically have 2 different components within that product, okay? So with whole life, it's just all bundled together as one thing. You don't need to think about anything. Universal Life, you have 2 different components. Here it is, okay? So the first component is something known as the cost of insurance, okay? And that's really just exactly what it sounds like, the cost of insurance, okay? The other component is the investment component, and these are unbundled, and you can move one up, move one down. They're completely flexible within certain margins, and you can really tweak it to whatever type of product that you want to create. So let's go over cost of insurance first. So with cost of insurance, there's another 2 components that you need to understand. The first is what's known as YRT, and what that stands for is yearly renewable term. So what that means is each individual year, the insurance company is going to assign you what it would cost for your insurance in that one specific year. So maybe it's $20 a year, but that means the next year it's going to go up because it's renewed every single year. So maybe the next year it's $21 and then $23 and then $25 and then $27 as you get older, hence yearly renewable term. Now, the other type of cost is what's known as level cost of insurance. So level cost of insurance is exactly what it sounds like. It's a level cost until death. So they're now basing the factor on they need to blend this out until you die. It's going to be a lot more expensive. Where maybe in the early years, the yearly renewable term would only be, let's say, $20. Maybe the level cost of insurance would be closer to $80. However, that's going to be a fixed cost all the way up until death. So it's going to be $80 the first year, the second year, the 20th year, the 50th year, and so on and so forth, okay? Now, that is where you can really start to tweak the cost of insurance so you can allocate more into the other component, which is the investment account. Now, the investment account is managed by you and hopefully your advisor. However, what I've seen in more cases often than not is that the advisor will sell these type of products and then they will be leaving the industry, they'll be moving companies, they'll be, doing something else, and you're really left on your own to try and manage this. So if this is a product that you're interested in, I would say make sure that you understand how it works and how you can change the investments and how you can manage them, because there's a good chance that your advisor will not be in the industry to help you. And I'm just telling the truth. I've seen this over and over again of clients that think it's being managed for them, but it's not at all. So if you're not going to manage it, I would not recommend this product. So how does that investment component work? Well, it works very similar to any other type of investment product where you can choose a variety of different investment options. Could be fixed income, could be stocks, and you will get a return within that investment account. Now, your return is tax-free up until certain limits. Now, the idea with Universal Life is you would have these two different components, the cost of insurance as well as the investment account, and you would pick a premium that you want. Let's say $100. Okay, $100 a month you're going to be putting into this product. So a portion of that is going to go into the cost of insurance. So let's say that's $20. The other $80 is then going into the investment account. And at this point, that investment account, let's say, is earning 4 or 5% or 6%. And of course, we know that's tax-free within these certain limits. Now, the idea is after a certain amount of time, maybe that's 10 years, 15 years, 20 years, or 30 years, whatever it be, the returns that you're going to be getting from the investment account are going to then pay for the actual cost of insurance. Hence, now offsetting it, and you don't have to pay premiums anymore. That's the idea with the product. The downside with this is a couple things. Number one, that investment account can go up, but it also can go down, okay? So you can lose money in this just like any other type of investment account. As well, you need to carefully manage the cost of insurance because maybe in the early years, it's good to have a yearly renewable term because then you can put more money into the investment account. However, as you get older, this yearly renewable term is going to continuously get more and more and more expensive. And so at some point, it's a good idea to then switch that over to a level cost so you can see exactly what you need your investment account to earn to pay for this cost of insurance. Now, the problem is what I find and what I regularly see with clients and people coming in that have Universal Life is they haven't managed it, they haven't looked at it, they assume their advisor was looking at it, their advisor's not looking at it and not managing it, and that yearly renewable term, is now up to the point where it's thousands of dollars, if not tens of thousands of dollars per year because they never switched it over, and now the client is, let's say, 60, 65, or 70, and they've paid into this product their whole life thinking that one day it would flip and they wouldn't have to pay for it anymore, but actually the inverse is true. Now it's so expensive, they can't even afford it at all, and they have to cancel the contract altogether, and they get nothing out of it. So yeah, Universal Life can be a really good product for some people. However, I would say that unless you're a very technical, sophisticated investor, you really like getting into the nitty-gritty of how it works, and you like all the flexibility and all the options and all the different bells and whistles that go with it, if that sounds like you, Universal Life could be the right permanent life insurance product for you. If you just want a simple, easy to understand, guaranteed option, you pay this premium for this amount of years, whole life insurance is the right product for you. I hope that answered some of your questions about different types of life insurance in Canada. If you guys have any questions, you can put them in the comments below or book a call with me on my website, affinitylife.ca. And if you guys are enjoying this content, all I ask is that you give it a thumbs up, and I'll see you guys in the next video.